So, hello friends. I hope you are enjoying this Typhon to Salary series. And in the series, and today I will cover FM questions of your CA Inter. You will say, sir, why we need to study CA Inter? Because these questions have been asked in ITC interviews and other companies' interviews, right? So do prepare. And these questions, like it will not take much time, but because I've tried to summarize these questions and uh, and their answers. So please get maximum out of this video also, and get to your work and do continuous what you are doing and stay on your path. You will definitely achieve the success. So starting with the first question, which is like, what are the long-term finance function decisions? So every organization have three long-term finance function decisions. These are your investment decisions, financing decisions, and dividend decisions. Investment decisions means that where we need to invest the fund. Financing means from where we need to borrow. And third, dividend means that what amount of wealth we need to distribute to our shareholders, right? So second question, what 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 is the difference between cost of debenture and cost of equity? So please note that this fact is not known to everyone, that cost of debenture is typically lower than the cost of equity. You will say, sir, why? It differs organization to organization. We read that we need to compare the cost of debenture and cost of equity, and then whichever is lower, we can take loan from by that mode. But understand a point that in the debenture, when we pay the interest on same, we get the tax benefit. But this is not be the case of dividend, right? So comparatively, if we see at the long term, then cost of debenture is lower as compared to cost of equity. Maximum times it is the case, right? So what is cost of debenture? Like this includes, right? So this is the case, and the cost of debenture is your is your cost to a company and to borrow the money from debentures, and cost of equity is to cost to the company to borrow the money in form of equity, right? Now next question is, these are some financial ratios which we need to answer. They will ask, what is debtor turnover ratio? It is net credit sales upon debtors, which is average debtors. Creditor turnover ratio is net credit purchases upon average creditors. Capital gearing ratio is long-term debt divided by equity. And what is inventory turnover ratio? It is cost of goods sold divided by the average inventory. So please learn these ratios. They will ask questions on these, right? Next is, what is cost of debenture? So you have read that two types of debentures are there. First is redeemable, second is irredeemable. So please learn the cost of debentures, how they are calculated by yourself. Like let their formula like I plus RV, RV minus NP divided by NP multiplied by 100, something like that. So please learn those formulas from your FM book or from the Google. Now next is calculation of cost of equity, right? Cost of equity, we calculate from five methods. First is dividend discount model. So its formula is DPS by current share price multiplied by 100 plus G. G means growth rate. What is EPS model? EPS model is typically used, but its formula is like EPS by current share price multiplied by 100 plus growth rate. And what is your Gordon growth model? It's your D1 by P0 multiplied by the 100 plus G. So it's expected dividend divided by the P0 means current market price, right? And earlier, like GDM, it is past dividend. Now in CAPM, what's the formula? It's your RF plus RM minus RF multiplied by the beta. This is your CAPM formula. And what's the formula of overall cost of capital WACC? It is cost of equity multiplied by the percentage of equity in total. Total means total D plus E. So it's share multiplied with the cost of equity, and cost plus करेंगे cost of debt multiplied by the 1 minus tax rate and multiply it by the weight of your debt, right? So cost of equity multiplied by the weight and cost of debt multiplied by 1 minus tax rate multiplied by its weight, right? So please do learn these formulas also. And next is, how do we calculate the value of firm? Two approaches are there for NI approach, and second is NOI approach. So they'll ask these approaches mostly in the exam. So that's why I've mentioned these two approaches only. In NI approach, how we calculate net income by cost of equity. Please learn that what is net income here. It is your EBIT, right? And how net operating income? It is your net operating income divided by cost of capital. So in first approach, we have used, so two approaches are there. First is your NI approach, and second is your NOI approach. So in NI approach, it is net income divided by the cost of equity. And in NOI approach, it is net operating income divided by the cost of capital, because the operating income is for your equity as well as your debt, because in operating income, we have not deducted interest expenses. Because how do we calculate it? Net operating income equals to your EBIT multiplied by 1 minus tax rate. So we have not deducted interest in that. So it is for equity as well as debt. So we have divided it by cost of capital. And for NI, it is for only equity shareholders. It is your PAT minus preference dividend. It is net income. So it is for only equity shareholders. So we divide it by cost of equity only, right? Now you have to read the profitability statement and its steps. What are steps? Like steps are like sales minus your cost equals comes to gross profit, and then you have to subtract the selling expenses. It comes it comes to your EBIT, then EBIT minus because selling and depreciation expenses, then it comes to EBIT, then interest minus equals to EBT, then minus tax equals to EAT, like this. So read this profitability statement also from your like book of Inter or Google, wherever you want. And now next question is, what are the three types of leverage and what are their formulas? Three types of leverages are operating leverage, financing leverage, and combined leverage. So formula of operating leverage is percentage change in EBIT upon percentage change in sales. It represents the sensitivity of operating income to changes in sales, right? And financial leverage, change in EPS upon change in EBIT. So it represents the sensitivity of net income to change in EBIT. What is net income? Net income is your like earning available to the equity shareholders, which is your PAT minus preference dividend, right? And what is combined language? Combined leverage, it is operating leverage multiplied by the financial leverage, degree of operating leverage multiplied by its financial leverage, right? Now, here are some capital budgeting decision formulas. These formulas are straight away asked in the interviews. So please learn these formulas and what is the reason behind these formulas. Do learn and understand its reasoning also. Like first is payback period. Payback period is like initial investment divided by the average cash flows. It basically represents that suppose 100 rupees you have invested and you are getting 50 rupees for 3 years. So in the 2 years itself, you will cover your initial investment, ignoring the present value, right? Second is your accounting rate of return, which is ARR. So its formula is average annual profit divided by the initial investment. So it represents that how much portion of our investment we are earning in a year, right? And which is average earning. Now third formula is NPV. It is your PV of inflow minus initial investment. So PV of inflow is cash flow divided by 1 plus discount rate multiplied by the time factor. Means, so it will represent some power by the time factor. So it will represent present value of your cash flows. So present value of cash flows minus initial investment equals to your NPV. And what is profitability index? It is present value of cash flows minus, here we will not use minus, present value of cash flows divided by initial investment. So it will be in like 1 point something or like that, or 2 point something, but NPV is in amount terms, right? So it's like percentage terms, and that's in is in amount terms NPV. So in PI, we can use this formula also, NPV plus initial investment. So it will come to present value of your expected inflows, right? Now next question is, now next formula is internal rate of return. What is this? The rate of return at which NPV of your project will become zero, right? And what is MIRR? MIRR is calculated like if you invest all your inflows till the terminal year. So we will arrive at till the terminal year cash flows by reinvesting it, and we will divide it by the present value of all the cash outflows, right? Like cash inflow at the terminal year and cash outflow, its PV at the initial year. We will divide it and we will like do a square root of it by using like 1 by n. N means number of years and minus 1. So we will arrive at the modified internal rate of return like this, right? Now next question is that what is standard deviation and coefficient of variation? Standard deviation means it is a dispersion of data, set of data from its mean. Suppose it's the mean, then a data is here. So what's the difference? And this from its mean. So it is dispersion of set of data from its mean. Like we have calculated, it is square root of summation of x minus mu. Mu means mean, x means number. So summation of x minus mu ka square divided by n. N means number of items. And what's its variance? We will not do square root here. So that's our variance. So what is coefficient of variation? Coefficient of variation is your standard deviation as a percentage of mean, right? Standard deviation divided by mean multiplied by 100. So it's your standard deviation divided by mean, which is coefficient of variation. Now next question is that what is the how the market value of shares and dividend is related. So basically, the market value of equity shares is influenced by the company's overall performance, plus its growth prospects and its promoters and market conditions, and not because of size of dividend alone. However, large or irregular dividend impact the investor's perception, right? Because as an investor, we want return on our investment. So it impacts the equity market price, but it is not the only factor because of which the equity shares price is influenced, right? Now, next question is that we have to tell the formula to calculate the share price using the Walter and Gordon model. So please learn these formulas also from your own. And final point is that how do we calculate the economic value added? Its formula is NOPAT minus capital multiplied by cost of capital. So how do we calculate the NOPAT? EBIT multiplied by the 1 minus tax rate. It's your NOPAT minus capital multiplied by the cost of capital. So means how much you are earning in exceeding your cost of capital. So that's how much value you have added, right? So that's economic value added. So that's all from my side for this FM related questions. Please do prepare these questions because these are general questions which you being a chartered accountant and being a finance professional should learn, right? So please prepare these questions and get maximum. So thank you so much. Please do like the video and subscribe to my channel.